Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full.
When we're talking in 2018-19 that the years of high growth are done, and by 2024, 2025, we're going to be plateauing and beginning to roll over, and then it starts to happen, I think it's telling us that our models are at least well calibrated and that we're picking up on what's actually happening. And according to those, which we have a huge amount of confidence in, we're willing to take this position that this move from high growth to no growth is the first step in going from no growth to negative year-on-year growth.
Hello, everyone. Welcome to this Finance University episode. I am your host, Dr. Chris Martenson, and today we are going to be discussing probably the most bullish investment thesis that I know about. Now, as you know, I like my hard assets. I'm a resource investor. I'm really bullish on things that are out of favor. I guess you could call me a contrarian, but hey, I like to buy things that are low when other people hate them and sell them when everybody's pretty giddy about the whole prospect. That's my approach. I understand there are other ones. Today, we're going to be discussing this, which is that what if the main narrative that the United States has been telling itself about its Saudi America, its endless amounts of oil, what if there's a crack in that overall narrative? In fact, what if we could go to reality itself and start talking about what's actually true? I think there's an enormous investment thesis, and nothing is ever for sure getting started until the economist says it's over. They're famous for this. So this is one of these most famous headline covers here. My attention was drawn to this by our guest today, who's going to take us into this thesis deeply. But here's the narrative. For years, we've been told there's something called peak oil demand. Demand is going to peak. And that's going to peak because of these electric cars that are going to just come in, eat the lunch of all the internal combustion engines. I think we're seeing that story get shredded, but at an awkward time, if it's true that U.S. shale oil production is hitting some sort of a geological maximum, not running out, but we're going to get into that more deeply. Today, we learned from the Brussels Times that last year, in 2024, in the European Union, the diesel market share for diesel vehicles rose by 1.7 percentage points to 84.5%. Meanwhile, electric vehicles actually declined by 9%, slipping from 7.2 to 6.1% of market share. This is not how this story was supposed to go. Peak oil demand has also not shown up in the United States, where we're actually seeing higher demand, record demand, as we saw in October of 2024. For its part, Goldman Sachs is also projecting that we're going to see more and more and more world oil demand to 2035, and then it starts to taper off. They've got an analysis around that, but what happens between here and 2035? That is 10 long years. Not much concern out there in the narrative structure. Here, Robert Rapier, writing in Forbes, says, hey, we just have energy dominance, more annual oil production, drill, baby, drill. That's the story. That's the new narrative. To discuss all this with us today, we're going to be talking with Adam Rozencwajg of Gehring and Rozencwajg here about this. This is actually one of the most powerful investment theses I've run across, and it really changed my mind, opened my eyes, and I can't wait for this interview. Adam, so good to be talking to you today.
Oh, thanks for having me. Really looking forward to it.
Well, where do we start with this? This thing right here, let me pull it back up again. Copper and uranium is the big headline, but underneath there, I've highlighted it, the depletion paradox. Could we talk about that for a bit? That really opened my eyes. And Adam, I've been tracking oil for a long time, and you taught me something about that I just was the whole Nixon era, 1970, Hubbard. Could just take us through that history. It's such a good story.
Okay, absolutely. I'm so glad you like a little bit of market history and financial history, because I can see people's eyes glaze over when I say, well, if you want to understand what's happening next quarter, let's start 1969, 1970, 1971. Yeah, but right. You really do have to sort of go back. And in fact, you almost have to go back a few years earlier than that to 1955. And at that time, remember, we were drilled the first oil wells really in the late 19th century. The U.S. was on a massive ascendancy, the world's largest producer. You were, starting to see exploration success in the Middle East and things like that. But the U.S. was the, elephant in the room. And a shale geologist named King Hubbard he was not a king. His name was King Hubbert, spoke to a industry group, an industry gala dinner, and he laid out his views why he thought that in 1970, he made two predictions, but let's just not get bogged down in the details. 1970, he expected U.S. conventional production to peak and roll over. And that was a really bold statement because, again, the U.S. was sort of everything in the global energy markets. And it was debated and prognosticated over the next sort of 15 years. And then sure enough, in 1970, the U.S. did peak and production rolled over. And what Hubbert based all of his views on was an intuition that, is somewhat, I suppose, trivial when you think about it, but has profound implications. It's really the idea that any field in the world is going to start at production zero, and it's going to ultimately produce all the oil that's there by the end. And so it's going to have this kind of S curve where it starts out slow, then it grows, and then it begins to taper off once all the production is gone, or all the reserves are gone. And the other thing that he felt, which again, I don't know, it's hard to argue with, the peak rate of an oil field is probably related to how big the oil field is. Meaning, if you have a field that has, 100 million barrels and a field that has 1 billion barrels of total recoverable reserves, chances are the one with 1 billion barrels will have a higher maximum production rate, barrels per day, sort of stands to reason. And putting those two things together, he made all sorts of predictions and extrapolations, and he concluded that once half the reserves of a field had been produced, then the maximum flow rate would be achieved and production would roll over. And he estimated that that would occur in 1970. Sure enough, it did. And so the whole world's attention came on to Hubbert at that time. And I'll talk about Nixon and what he did in a second, because you have to take it to today in order to really appreciate what happened.
Yep. Can I just want to talk about how bold that prediction was. So this is oil production, and I've put in the green big arrow. That's where he made his prediction. That's kind of like 1998. You say, I think this internet's overblown, right? It's a tough call because it's nothing but it's just going up.
Absolutely. No, it was a very, very bold call. And, in a lot of ways, frankly, to say that shale production is over now is a lot more straightforward than what he did. That was a really out of consensus call, and it was dead right. And it had a huge implication because the only source, or the major source, of non-OPEC oil supply growth, the U.S., stopped, and OPEC gained market share, it gained pricing power, and obviously in the 1970s it used that market share and pricing power twice in its oil embargoes on the West, the huge impacts. You basically had a decade of stagflation. You had a decade of gas lines and energy security concerns, and by the time the decade was out, oil prices had risen over tenfold, and oil stocks had been obviously the best performers of that decade. Now, fast forward to today. Lots of people have dismissed Hubbert's views today. Why? Well, conventional production kept on declining from 1970 all the way to 2010 in the US, and then the shales came online and it bucked the trend. Now, the question is, if you want to say that Hubbert got something wrong, he didn't factor in this new source of oil that was all of a sudden going to come to the fore and come to dominate the world. But conventional production has continued to decline and continue to decline. And I think that's an important lesson because it's one about technology. Technology will ultimately save the energy industry, but there can be massive dislocations in the middle. And that's exactly what we saw through the 70s. So the shales come online. They weren't discovered per se. We always knew that the shales were there. We just never had the technology to be able to access them. That explains why they came online so ferociously, because once we had that missing key to unlocking them, we knew exactly where they were and we got after them very, very quickly. We had drilled into shale for 100 years, basically. And so we had a huge catalog of the best shales. We knew what was oil bearing and what wasn't. We just didn't have the technology, the horizontal drilling and the fracture stimulation. George Mitchell of Mitchell Energy figured that out, and it was off to the races. And we bucked a, 4-decade trend of U.S. oil production declines. And of course, as we all know now, the U.S. is the biggest oil producer in the world. As we know now, we effectively, between oil and natural gas, brought on 2.5 Saudi Arabias. But what no one thought to ask was whether or not the shales would suffer the same depletion issues as conventional production. Would shales ultimately roll over? And at the beginning, there was some doubt as to that. Then there's some technical reasons. The shale plays are much bigger, aerially extensive. They run for hundreds of thousands of acres as opposed to conventional oil pools, which might be 10, 20, 50, 100, 200 wells that you can get. We have tens of thousands of wells into the shale. So there was this view that it could just be manufactured and repeated forever. But something happened I'm sorry, go ahead.
Yeah, no, I think very visually. So I just want to, because we're piercing a narrative here. Here's the narrative. The narrative is, wow, look at, here we see that oil was rolling over in 1970, and then here it is now. So therefore, this is how the world works, and we'll probably just have another peak after that. I think that's the narrative. And I consider this a chart crime because this is the actual chart from Art Berman that we should be looking at. Green is conventional. We'll call that also cheap and easy oil, right? And then even with everything that happened, we brought on the Gulf of Mexico and Alaska. And guess what? It still went down until this red stuff. So this to me, Adam, I see people focus on this and you can't. This is too simplistic. You have to understand. Now, I will note that conventional oil peaked in 1970 and it's never recovered, despite all this magic new technology.
Absolutely. No, it not only has it not recovered, it's never bucked its downward trend. And if you were to go back to that chart for one quick second,
yeah,
and if you were to remove everything except the red and only look at the red, you would see that that is tracing out the left-hand side of the green. It's coming up and now it's beginning to slow. And all the principles that you could apply to the conventionals, you can apply to the shales. And we've known that. And this is where I think the investor community's really gotten things wrong. We've known that since 2012, because in 2012, the first two shale basins, which is the Barnett and the Fayetteville in Texas and Arkansas, respectively, they peaked and rolled over. So we know that these things do peak, but no one learned that lesson because those were just like the opening salvo of the shales. We brought on the Permian after that, the Bakken, the Eagle Ford, the Marcellus. It overwhelmed the Fayetteville and the Barnett, but we could still study those fields and make some conclusions and some extrapolations. And one of the things that we realized is two things really. First was that we thought that the shales would follow the same trajectories as conventional. And second is that upon closer inspection, they actually peak and roll over a little earlier in their life cycle. So if conventional rolls over once half the reserves have been produced, shales have actually rolled over once like 35 to 38% of the resource has been produced. And when we then use that to look at the Permian, which has been driving oil growth, or the Marcellus and Haynesville, which have been driving gas growth, we came to the conclusion that 2024 would be the year that both of those rolled over. And sure enough, shale oil and shale gas peaked out in November and December of 2023, and they've been declining on a month-to-month basis ever.
So, Adam, I want to just take this very stepwise to make sure everybody's tracking along. So conventional oil and gas is typically formed in a pocket. It's got just the right geology, and there's real liquids down there in a rock matrix, but very highly permeable rocks and all of that. But that's flowing from what you said, the shales are sitting under there. This is organically rich rock. It's been cooked at the right temperature. That's called the parent rock. I just want to be clear in case anybody's thinking, well, we went from the child to the parent. There must be some grandparent behind the scenes. This family tree only has two branches. Is that correct?
That's right. What happens is organic matter gets deposited on a seabed floor, and it gets covered and it gets cooked. And all of that organic matter is basically long chains, everything else gets cooked off, and what you're left with are long chains of hydrogen and carbon put together. That's a hydrocarbon. That's why it's called a hydrocarbon. And depending on how long you cook it for and under what temperature and pressure, it starts out as basically, the equivalent of like peat moss type of, gunk. And then it eventually boils down to oil, first tar, then oil. And then eventually the purest is natural gas, which is just, the shortest hydrocarbon string that you can get. Over time, and the rock that's cooking in is effectively, you can think of it almost like concrete or cement. So concrete and cement, you don't think of it as porous and permeable, but it actually can absorb water for sure. It just doesn't do it in the same as like a sponge would do it, for instance. And so you have within this cement moisture in the form of hydrocarbons and some water. And over time, that begins to very slowly migrate out of that cement. And whenever rock is around will determine what happens next. If it is just permeable and porous rock without any type of a trap on top, it'll eventually seep all the way to the surface. And we have seen lots of surface expressions of oil and gas over the years. Or if there's an impermeable rock layer on top, then what happens is it collects in these pools of very sponge-like sandstones and limestones, and that traps it in very high concentrations. So all of conventional oil and gas has been going into what I would call those sponges that sit below an impermeable salt layer or other type of impermeable rock and accessing the oil and gas there. What we're doing now, we're going into the cement and we're rubbleizing it. We're putting a huge amount of energy. We're introducing pathways for that oil and gas to migrate out, and we're sucking it up the wellbore. That's why we have to go horizontal, because these are like big tabular blocks of like sidewalk cement, as opposed to sponges just sitting around under the surface. That's of course a little bit oversimplified, but I think it drives home the point.
Yeah, I was holding in my hand a piece of a shale layer that they'd pulled up from very deep down, and it felt like the chalkboard we used to have in schools. It was literally that substance to me. It was a little greasy, but it was rock.
That's right. And so like. there is hydrocarbon in there, but it's not the same as something that can soak it up. And so we have to go in, we rubbleize it, we introduce these pathways for the hydrocarbon molecules to flow, and we pump like hell.
Okay. And the second thing I want to establish, since there is the shales, that is the source rock. That's the first stuff. The second is this idea that we kind of know where they all are, right? I mean, there's, I think the Barnett's sort of missing from here. There's a few, but these are the biggies, right? These are the big shales that exist out there. And I just wanted to show people that the Haynesville and the Appalachia, which is the Marcellus up there, those are principally gas, right? Because as you said, those got cooked down to the single molecule, precious molecule. And the rest of them are sort of some mix. Eagleford's kind of very light oil / gassy stuff, et cetera. But is this roughly the picture that we should be working with?
It is. And, I'm trying to look here. It looks like maybe the Wattenberg. Oh, I guess, yeah, that's comprehensive. And again, what it comes back to is the idea that in the conventional world, you were spending a lot of money on exploration, looking for those sponges that were hidden under the ground. You knew, though, every time you tried to look for one of those sponges, you would drill all the way down until you hit the source rock, the shale. And so we had mapped all that shale all around, frankly, the world, not just the US. We have really good shale basement data across the globe. It's all been compiled and put together by the US Geological Society over many, many years. And what we were missing was the horizontal drilling and the hydrofracking to liberate that oil and gas. And so once George Mitchell figured that out, like I said, it was a very, very quick study for everybody else to say, okay, really the only impediment, frankly, in the early days of shale was money. Was the idea that, if you were an investor, would you pay an E&P company to go out and drill the Bakken for the first time? So that had a bit of a, time lag, but it happened really quickly, and that's why we were able to bring them all on. But the flip side to that coin is there's not a shale exploration boom that's going to go forward, certainly not in the United States, and I would argue not really on a global basis either, because we know where they all are, and we've gotten the best ones first.
Hello, everyone. I just wanted to take a quick break to tell you about Peak Financial Investing. Look, my whole goal in life is to help you be prepared, to help you be resilient, to have you have the freedom you need in order to live your life in the way you want to live it. And top of that list is financial freedom, making sure that the money you have saved accumulates appropriately and isn't lost to some random process of market downturn or something like that. Peak Financial Investing is a place where we will connect you with our endorsed financial advisors who understand the world the way we do. You deserve to talk to somebody who is not going to look at you like a dog listening to white noise when you say, hey, should I invest in gold? Hey, is the dollar going to be okay? Hey, are there any big risks here? Are there any bubbles we need to be aware of at this time? Great questions. So when you ask those, you deserve to speak with somebody who's got good answers, thoughtful answers, and knows most importantly, how they're going to respond nimbly as the world around them changes. Now, this is one of the periods of the most extraordinary changes we're going to see in market structure. China's coming up and rising. Geopolitical tensions are afoot. We have all sorts of realignments happening. The federal government is deficit spending like nobody's business. You know the Federal Reserve wants to get back to printing like crazy. We understand that gold is popping to all-time new highs. The story has changed. Your investment philosophy needs to be nimble and responsive to that. So, at Peak Financial Investing, we'll connect you with people who see the world that way, who understand how to run what's called a risk-managed portfolio to account for all the changes that are coming. Because if the Hippocratic Oath is first do no harm, our oath is first take no punishing irrecoverable losses. It's time to manage risk, it's time to understand how the world has changed, and it's time to make sure your portfolio of savings and wealth are there for you and can meet your needs all the way through your retirement. Now, back to our program. Let's back up a second, because you said what M. King Hubbert did back in 1958, 6. When was that? He was really, it's actually simpler now because we can calculate these things a little bit differently. So let's look now at the Bakken and the Eagle Ford, because from your third quarter report last year, you had this little chart set, which is the Bakken and the Eagle Ford. And the green, the actual is that sort of greenish line, but then there's that red prediction line. That's the heart of what we're going to talk about today. It's phenomenal to me that you've got a model that can begin to wrestle with this, but shale dynamics are different from conventional dynamics. What's your model, Adam, and how did it do what it did here?
Sure. So what our model did, it was two steps, really. The first step was, we were talking before, production rates must be, at least according to Hubbard, and I agree, somewhat related to the size of the field. So how do you determine the size of the field? And again, with shale, it's fundamentally different, because with the sponge, you can sort of take a more finite view. You can say, well, here's the delineation of the sponge. Here's how much volume it actually contains. There's a pretty rough window as far as how much oil or gas would be contained in that sponge, etc. You can make some assumptions. The tricky part there is predicting how many undiscovered sponges are left. Shale's different. Shale runs for hundreds of thousands of acres. It's fully delineated. We know where it is. But the question there is to determine roughly how much each well will deliver, how much reserves per well, because then you can begin to try to estimate it. And the reason that's so hard is that a lot of things have changed in the shales in the 15 years that we've been developing them. You know, we started drilling 3,000-4,000 foot laterals, pumping a certain amount of sand and water and fluid down to fracture stimulate that. Now we're at, 15,000 foot, 20,000 foot laterals in some cases. You're talking about, introducing, hundreds of times the volume of proppant. And so even the same well in the same area over time would have evolved and changed. So how do you try to take a stab at calculating all the oil and all the gas that's underground? And we and the rest of the industry in the middle part of the 2010s had all kinds of estimations and models, and some were good and some weren't good. And frankly, there was a lot we had left to learn. And in the late 2010s, around 2018 and 2019, we turned to at that point, the emerging practitioners of AI and machine learning. We were very, very early to that. It's funny, and we'll talk about AI later as it relates to demand and stuff. Everyone today fancies themselves an AI expert. And by no means do I want to insinuate that, we can create large language models the same way that OpenAI does. But we understand the mathematics behind it, because we've been studying neural networks and the architecture and the systems and the technology for over 10 years now. And we started to put it into practice in 2018, 2019. So what we basically did was we built a very sophisticated, deep neural network, artificial intelligence engine that, if you talk to my partner, Lee, he says, we sit there and we ask it questions. Well, he really asks me questions and I ask the AI questions. It's not a conversational model. In a lot of ways, it's a lot simpler. It takes a series of inputs the geology, the thermal maturity, the oil, total organic content, the pressure, the thickness, the permeability, the porosity, all these different things, the clay content. And then it also takes as parameters how you drill the well, how long the lateral is, how many stages you use, how much proppant, how much fluid, etc. And what you're trying to get back from the model is the production profile of the well. And we have lots of wells now that have produced for a long time, and we have good production data. And really, honestly, if you have the first 12 or 24 months of that well, you can extrapolate the rest of the production data quite well. So we have lots and lots, tens of thousands of wells across all these different basins. And we got to work training that model using hundreds of millions of what they call neurons, and the training runs would take days and things like that. And what we got back was a really accurate model that predicted, based on where you drill the well and how you drill the well, what it's going to return to you as the oil company and ultimately to society. And from there, we could then start to catalog the entire basin and say, what's our estimate for what this entire basin's going to produce? And the other thing that came away with, and this was really, really important, was you might remember in 2014, Saudi Arabia decided that they were going to tank the oil price. And there was lots of reasons that they did to do that, but they decided to add production. The market was pretty well balanced, and they added 1.5 million barrels a day. It pushed the market into surplus, and inventories built up, and prices went from $100 to $27. And then finally in 2016, they pulled back and the price started to slowly recover. And in that period from 16 to 18, after the prices started to recover, that was like the golden age of shale production. And when you ask, production surged. We had 2 million barrel year-on-year growth in some periods. And we were doing it with far fewer rigs than before. And when you asked the industry how that was possible, what they came back with was the idea that they had gotten much better at drilling the wells. They understand the shales better. They could steer those laterals much more precisely. They could inject just the right amounts at just the right places, and they could effectively turn what had been a really lousy well into a really good well. The problem was none of that was true. And I don't want to be sort of too bold there. There were some improvements. The engineers were able to achieve some success. But what the industry really got good at in that time, and what really drove the increase in productivity, was that they got really good at figuring out where the best wells were and directing all of their time, attention, and rigs to those best areas. Now, why is that so important? Well, if you were turning fringe, marginal, lousy acreage into totally productive tier 1 acreage, you were increasing the size of the pie. But if you were just going into your best areas and really drilling them very quickly, you were hollowing out your crown jewel asset. Very, very different, particularly from our perspective, where we wanted to say, how big is this thing? One is increasing the size of the pie, one's not. And so from there, we concluded that yes, these things, we can try to take an estimate as to how big they are. They're not getting bigger, they're getting more efficient, but they're not getting bigger. And from there, we applied some Hubbert principles and concluded back in 2019 that 2024 would be this magic inflection year. We actually became bullish back then too, because we said growth over the next few years will not be as good as it was before. That second derivative was beginning to slow, but obviously COVID came in, and then ESG pressures came in, and no one cared about that. And all anyone now cares about is when production actually rolls over. And it's happened. That's what's so shocking. It happened 12 months ago. The Permian is the only field now that's showing any growth, and that growth has gone from 1 million barrels a day to 100,000 barrels a day. And I suspect within a month or two, it'll actually be negative year on year.
I'm gonna carry on with that, but first I want to a really important part that came out in your commentary that relates to all this, because this is the argument I get, Adam, from people is like, oh, prices will go up, more will come out of the ground. Can you just walk us through what happened in 1970? I pulled this from your commentary up there. Just astonishing. People can read this. But prices went from $3.18 a barrel, you're saying here, to $34. I mean, let's just put this in context. That's going from 70 to 700,
And let me just couch that a little bit. Prices rose tenfold, but from the lows. And I suspect if you look back on this cycle, the low probably would be 20 on a monthly basis during COVID.
Okay, all right, that's fair. Yep.
And so I think 20 to 200 is a decent estimate for where this cycle will peak. Now, when it went from 3 to 35, 35 by 1981 wasn't sustainable, and prices fell after that. And I suspect 200 will be tough for the global economy to stomach, might not be sustainable. But we are in this potentially tenfold increase, going from 20, I think, ultimately to a high of 200. And remember, only 2 years ago, when Russia invaded Ukraine, you got 120, on a spike. And so I think 200 is certainly in the cards. But this is what gets to the paradox, okay? Because what I've been telling you so far is geophysics, geochemistry, common sense. Nothing's paradoxical about it. This is the paradox. Conventional production rolled over at 50% produced. 50% of the reserves produced. We think shales actually, for some reasons we can get into if there's time, will roll over at about 37 to 38% produced. What does that mean? That means that when production rolls over, there's still 50 to 60% of the oil and the gas left in the ground. The industry doesn't think that there's a problem because there's still lots of oil there. However, we don't produce until there's nothing left and then go to zero immediately. We happen to kind of follow this bell-shaped curve where we peak much earlier than anyone appreciates. That's the paradox. So how did it manifest itself in the 70s? And I think the analogy to today is so important because, the administration is really dedicated to drill, baby, drill. The three arrows, one of the three arrows is adding 3 million barrels a day of oil equivalent. Now, they didn't say equivalent, so I think they sort of hedged their bets there a little bit because there's some gas in there too. But nevertheless, I don't think that's going to be achievable either. So what happened, and why do I think this analogy is so pertinent? Well, in 1971, following the first Arab oil embargo and the gas lines in the United States, there was a huge push by the administration to relieve our dependence on international foreign oil. Right? The conventional production had just rolled over. That was sort of new for us. We had been used to ever increasing production. It just had rolled over. Saudi turned off the tabs following the Yom Kippur War in Israel and the US's involvement there. And Nixon launched Project Independence. We were going to regain our energy independence, and there was this one, at that point, 1 or 2 year sort of peak and flattening and slight decline. That was nothing to worry about. We were going to get back after it. Maybe we got complacent. Maybe prices weren't high enough. Maybe regulation was too high. All the things, that are true today. And so he announced a number of initiatives to help the oil and gas industry. He made it very easy to permit new wells. He made it very easy to get pipelines in place to help deliver that oil. And then what was kind of different then to now is part of that was that he was looking to deregulate price and allow prices to rise. And today, that's anathema, right? Politicians want to keep prices down. But remember, back then, the issue wasn't so much that the oil and gas price was hurting people. It's that we didn't have the volumes. We were sitting for hours of each day in these gas lines. Nobody cared if they were going to pay us a little bit more at the pump. What they wanted was the actual volume. And so by allowing prices to rise, deregulating some price controls that were still in place at the time, and allowing permitting and pipelines to move much faster, Nixon was convinced that he would alleviate this problem. And, he spoke to the industry, and I think this is really important when you think about today. The industry said, look, if you make it easier for us to drill and you give us a little bit more price incentive, we're going to get after it. I know where those wells are. They're not productive today. We can't make them work in the current regulatory environment, price environment. But if you make that better for us, we're going to increase our activity and we're going to increase production. And they have held their end of the bargain. They increased the rig count by 4-fold over the next several years. I think you have it there in that data. And the prices, put in the right price incentives, their prices were higher. And so the companies made good money. They did everything that they said, but aggregate production continued and continued and continued to fall. It had a mild respite there in the 1980s, and then it continued its march down in the 90s and the early 2000s. And that's the paradox. That's where I think people have a really hard time understanding this, is that we can put all the right incentives in place, but when the problem is geological, as it was in 1970 and as it is today, you can put all those right incentives in place, and the companies can increase their activity, but you're not going to get the response that you wanted. Even though the rig count went up fourfold, production fell another like 2 million barrel, big numbers. By 1979, we were in a much less energy independence, seems much farther off than it did at the beginning of the decade. And so I think that's exactly where we are today. This geological principles of this, the models are the same. They're Hubbard's principles. That's what people didn't get then, and I think that's what people are not getting now. And so that's going to have a huge implication. And I'll just say one thing to kind of cap this, because I think it's a good way to think about it. We're going from an era of geological abundance to more of an era of scarcity. And in an era of abundance, we think that all it takes is the right policy, the right price signal, the right administration. It's there for the taking. All we need is to be able to have the will to get after it. In the period, though, of energy or resource scarcity, it's a much different feeling. Copper feels a little that way today. It feels like there's nothing we can do to boost copper production because we don't have the mines ready to go. And oil's making that transition, and gas is making that transition from this philosophy or this aura of abundance to one of scarcity. So it's not even on people's minds. They just think that, all it takes is the right policy and the right administration. And I don't think that's true.
Well, Adam, what could Trump do? So you mentioned, is there anything he could do to make it feel like oil's trading in the mid 80s for oil companies by shaving $10 per barrel off of their input costs on the front end? I mean, is there anything in terms of regulations, leasing, tax breaks, short of subsidizing? What could Trump actually do here to boost production?
Well, that's a really interesting question also, because for all the bluster of the Biden administration against the oil and gas industry, other than, Keystone, it's hard to really point to anything that they did to really hamper the oil and gas industry's ability to generate production. I mean, if you could make the case that releasing oil from the SPR depressed the price, and that made it a little bit trickier for these guys to drill. But I think that was just a midterm election phenomenon more than it was anything else. So what could Trump really do? Before I get into that, I'll dodge your question a little bit. Okay. I've done this nearly 20 years, and Lee's been doing it nearly 40 years, and I think to be an oil and gas investor, you need a couple things. First is you need to be able to look at the big picture, and you need to widen your possibility of potential outcomes. I think people are way too narrowly focused on oil being up $5 or down $5. I think in the oil markets, you have to be open to the fact of these tenfold moves. I've seen oil in my 17 years, not very long, go from 10 to 140 to 27 to minus 45 to 120 to 60 to 80, and that all happened with a market that was only out of balance plus or minus 1%. So it's a very volatile market. And I don't think that any oil or gas analyst who's actually seen anything would say, there's nothing that could happen that would take $10 off the oil price in the next 6 months. I've seen all kinds of things. So in the short term, markets will do what markets do. I'm more interested in the longer term. And in the longer term, there's not a lot of levers to pull unless you get more fields, more reserves waiting to be developed in a really honest to goodness manner. And we just don't have them. And they're not out there because we've explored all over. So from a bigger picture perspective, I think the thesis is incredibly likely that oil prices trend much higher over the next 5 to 10 years. Is there anything that could be done in the absolute short term to get, a short-term spike in production and depress price? Possibly, but again, you're doing this over this backdrop, right, of tight geology. And I promise you that in 1971 and 1972, if there was something that Nixon could have done, it snapped his fingers and seen a huge price fall and supply response, he would have done it. People tell me all the time, Exxon has lots of engineers out there and don't ever sell them short. And I totally agree. The engineering community and the petrochemical and physical community are amazing. But Exxon had a lot of engineers in 1972 also, and they were working awfully hard at trying to fix those problems. And when the geology is working as a headwind, it's really hard to overcome. So with that said, what could Trump do in the short term? There's obviously talks of ANWR, the Alaska National Wildlife Refuge, coming online. There is hydrocarbon assets there. It's not enough to move the needle if all the shales are actually starting to decline, as we think they are right now. Are there some debottleneckings in certain regions that are under pipeline constraints and things like that? Possibly, but not too much at this point. So I don't really see that as a major impediment. Shortening the permitting timeline for new wells. Again, if there's not the new wells to drill, then I don't know what shortening that timeline is going to do. In the month that you make it much shorter, could you see an increase? It's possible, but if the wells aren't there to drill in the first place, that's going to be, you're just pulling in growth from the future, and it's going to make depletion even worse. I've heard people talk about pressuring Saudi Arabia into increasing its production. We can argue whether that counts or not. I suppose, if his goal is just to keep prices down and he gets a response from Saudi, that's possible. But Saudi has massive geological problems of their own. Matt Simmons, who is a energy investor who died about 10 years ago, he wrote a book in 2005 called Twilight in the Desert, describing all the problems facing the Saudi fields. And you know what? Since then, production's never really made a new all-time high. They pull some production back and they add it back to the market, but you've never really, on a sustained basis, been able to get much above 9.5 or 10 million barrels a day. And actually, Saudi, which had always claimed that they were working towards 13 million barrels of capacity, has now abandoned that. And ironically, again, in this age of plenty, that was taken as very bearish by the market, because that was sort of a claim that Saudi doesn't think there's a future of oil. I can promise you that Saudi thinks there's a future in oil, and I can promise you, at least according to our models, that the reason that they've abandoned that target is that it's going to prove fiendishly difficult to do. So I don't see where the silver bullet comes from. And, we disagree with the administration on that. And administrations get it wrong. The Nixon administration got it wrong. We've seen plenty, frankly, over the years of U.S. presidents and administrations that have not properly understood how you can grow production. But we'll have to see.
All right. What about the East Coast? I mean, Biden just signed some EO that said, taking all the coasts out 635 million acres now taken out from 1958 Coastal Act. Anyway, thoughts there? I mean, we haven't really, as far as I am aware, really fully mapped, done our latest, 3D seismic mapping of the East Coast in particular. Anything there? And how long would it take if we did find something there?
Well, so again, two really good questions. First of all of that area has been available for exploration and development and has not been explored or developed. So I think that should probably tell you something as far as where it ranks on any of the oil companies' lists of priorities. Is it possible? I mean, we have to wait and see. But like you said, there's going to be a lot of time and a lot of lag from exploration to ultimate development. And remember, deep water, and we're very bullish on deep water. We think that as the shales start to come off, people are going to dust off the old playbooks, the projects that were ready to go before shale came in and ate everyone's lunch in 2010. And that probably will include a lot of offshore. And so we own a bunch of the offshore drilling stocks. They're dirt cheap. We've not built new rigs in a long time. In fact, most shipyards won't even build you a new oil and gas. They've gotten out of the business entirely. So I think it's quite a good thesis there. But I'm not sure that the east coast of the United States is going to be the panacea that anyone is looking for. And so, bringing that back, I mean, gosh, how long was that, off the table for? It's a matter of months, right? So it wasn't an issue before, and I don't think it'll be an issue again this time. And the offshore does take time to ramp up. And let me be clear about that, right? I do think that if you look forward 10 and 15 years from now, we're going to consume undoubtedly substantially more energy than we consume today. And I think that oil and gas will make a big part of that. So by extension, production, every barrel of demand has to be a barrel of supply. So production on a global basis probably has not peaked, and I suspect will move higher. But what matters are these shorter term dislocations. And when I say short term, they could be 10 years or so. So you look at global oil production in the 1970s, and we produce substantially more oil today than we did back then. And even, by the way, in the early 2000s, we were producing more than we did in 1970. But the main source of non-OPEC oil growth slowed. What everyone had relied on was starting to slow. And that changes the dynamics, and everything in the oil market's on the balance and on the margin. And so that's enough to see prices go up dramatically. We brought on, after that price spike, we brought on the North Sea, we brought on Cantarell, and those fields started to exhibit their own Hubbert's curves and own Hubbert pressures beginning in 2003, 4, and 5. And lo and behold, that's when oil prices went from $11 to $145. Again, a tenfold increase, right? So we still produce more now than we did then, and global production never peaked. However, when you have the major source of non-OPEC oil supply growth begin to slow, that really throws the market into a bullish tailspin, and prices move much higher.
Yeah. Now, thank you for that. Fantastically well said. Please excuse my really, really rudimentary art skills, but I'm coming back to this Art Berman thing, and we see the tight oil there in red. So what I've done here with my ultra sophisticated Microsoft Paint tool is ask the question, what if we pulled 40% out and 60% is left? And I get this. Okay. I don't think anybody's ready for this. I think our narrative structure is not even remotely ready for this. In fact, if I could, I would bring on Billy Bob Thornton in that famous windmill scene in Landman to talk about how we don't have a plan B for this at this point in time. I just want everybody to understand, if this is reality, and I'm not saying it is, but if it is, you should have some portion of your portfolio dedicated to that. But this has geopolitical ramifications. If I'm Canada, I'm starting to sweat a little bit, but this chart in the past has led to wars and large ramifications because oil is non-negotiable, as that famous scene from Landman, which people haven't seen it. I highly advise you see it. We have a 150-year infrastructure of living on the stuff that's in the colors there. And
no, I think that's a very, very powerful chart. I think your Microsoft Paint skills are very good, in fact. And again, as you can see, and we can argue about the shape of that curve, right? But as long as the trend is the same, that's what brought in the 1970s. That's what brought in the major challenges that we faced in this country throughout that decade. Because remember, the economy is nothing more than energy transformed. Every part of the economy, I don't care what it is nothing. I would actually argue that society, civilization, and the economy is transforming energy from one form into the other. And what we use to measure that is this proxy of GDP and stuff like that. And
thank you.
Oil and gas are incredibly productive. They are incredibly efficient. When you drill an oil well, for the amount of energy that you put into the ground, what you get out, there's nothing that competes with that except for nuclear. So I do think that nuclear is the next logical progression, but compared to an agrarian lifestyle like we lived on before, compared to windmills and solar panels, we're talking about a 5-fold increase in the efficiencies that you get moving to oil and gas. That's what has unlocked the modern world. And that, without sounding too, dramatic, is what's at risk. And you can see it in Germany. Germany has moved from a very high efficiency economy, one where they were powered by natural gas and nuclear energy, two of the most efficient energy converters in the world, to windmills and solar panels backed up by batteries, some of the worst. It's effectively the same energy efficiency as an agrarian lifestyle in the 15th century. And you know what? They cannot support a modern economy on that. They cannot support industrial manufacturing. They cannot support a good standard of living even for their population, but they certainly can't support manufacturing. And so these have really big ramifications. And I think that we underestimated what a tailwind the shales and cheap efficient energy has been for the last 15 years, and we're certainly underestimating what a potential headwind it could be.
This is such an important point because Germany is busy deindustrializing, right? And they were sacrificed at the altar of what I call abstractions, right? Clean, green energy is an abstraction. It made sense, but it didn't transfer over into this thing called reality, which is I need stable, cheap, abundant power in order to run my underlying economy, and that is the source engine for their prosperity, where things like steel, borosilicate glass, cement, car manufacturing, etc. And everything else was built on top of that, and they're busy dismantling that. And I just don't see any signs yet that they've figured that out as a nation state. But
No,
I think
I agree. They seem to be doubling down in a lot of cases. And, look, I don't know, maybe game theory says if you're sort of so far snookered, the only thing to do is double down. I don't know. Yeah. Common sense to me would dictate that you go in the other direction as quickly as you can. But, I don't understand the German psyche, and I don't pretend to.
Yeah, no, but we shouldn't be over here in our economics journals. We have to go over into our psychology texts to figure out what's happening there. So you mentioned... Listen, we went through some of the shale plays. It really kind of dials down to, and this is according to the EIA, Energy Information Agency in the U.S., if you sort of decompose that, you got federal offshore in the light blue, everything else in the darker blue, but at the bottom in the darkest blue is the Permian region. If you sort of squint at this is really a Permian story at this point. That's what we're down to. I mean, we can almost safely ignore the rest of it. It's either not growing or declining. So, in your report, take people through, Permian is composed of different sort of regions. It's got different benches of things. But two of the biggest important regions, Midland and Delaware, A, what are they? And B, what are your models telling us here?
Yeah, so the Midland and the Delaware, the Permian Basin is in West Texas. It's a unbelievably prolific oil field that has had a few leases on life. The first time, and there's a great book called The Big Rich, which talks about 4 major oil families in the United States and how they effectively made the U.S. what it is as far as an energy powerhouse. All conventional, by the way. This is all pre-shales. And the Permian Basin was basically opened up by Siv Richardson. And if you looked at the history of oil in the United States and in Texas, early on, East Texas and South Texas was really where the oil and gas business was. And nobody had the audacity to go into West Texas and see if it would produce. And in fact, the first, I don't know how many wells were dry holes, and like so many great oil stories, they were down to paying their crews and IOUs and script at the local grocery stores and stuff like that. And then the wells started to come in, and it became an unbelievably prolific field. But it is a field that really has 4 parts, but 2 of the parts are important from a shale perspective, and that is the Midland side, which is more on the east, and then the Delaware sub-basin, which is on the west. They're separated by the Central Basin Platform, which is an upthrust in the middle that was productive on a conventional basis, but is not productive from a shale perspective. And when you look at the Delaware and the Midland was developed first. Pioneer was the big company there. It's, of course, now been acquired by Exxon. And the Permian Basin produces both oil and gas, about 60% oil, 40% gas. Let's call it basin-wide. But in the Midland, it's a little oilier. And in the Delaware, the wells are bigger. They're more productive. However, they're gassier. So on a BOE, a barrel of oil equivalent, in energy, total energy, they're a bit bigger but lower value product. Gas being cheaper than oil in this country. Both sides are now, I think, months away from rolling over. Both sides have certainly seen their growth slow quite dramatically. And if you look on a year-on-year basis, and this chart was done a few months ago at this point, but if you look on a year-on-year basis, you started the year at about 400,000 to 500,000 barrels a day year-on-year growth, both sides added together. That, of course, was already down from over 1 million barrels at its peak year-on-year growth. You're now down to 100,000 barrels year-on-year growth. And you did get a new high in November, I think in both sides of the field. I double check that, but I believe on both sides. Certainly combined together, you got a new high in November, but you're talking a new high by like 10,000 barrels from the old monthly high, right? So one of the things that I have found frustrating is that if you go back to 2018, when we first started to get bullish on oil, we first started to feel that these shales were entering midlife, if not, old age. We were at a period of time when production was growing 2 million barrels plus a day year on year. And we said that's going to slow and roll over. Well, now you're down to 100,000 barrels a day year on year. And people love to say, and I even had a slide, oh, new record high. Oh, what are these guys talking about? They keep making new record highs. It's missing the forest for the trees a little bit. We've slowed dramatically. And now we're just kind of bouncing along that plateau before we think that the productivity or the production rolls.
This is from Ovi over at Peak Oil Barrel. He does a great job sort of giving us nicely easy to see colored charts. And this is coming from the short-term energy outlook from the U.S. EIA, decomposed into total USA in green, lower 48 in red, with forecasts in the dark and lighter blues. The whole next year, according to the EIA, and I consider them super bullish usually, that looks dead flat to me.
No, it is. It is. And like I said, up until, I think we just made a new high by about 10,000 barrels, but up until a month or two ago, the monthly peak was actually made in November of 2023. So we're in a no growth world. And I think what it really comes down to, right, what investors have to really ask themselves, and everyone has to come to their own determination. I obviously have my views, but the question is that we were in a growth period, a very strong growth period, some of the best growth that the world has ever seen in terms of oil production. And now we have for 12 months effectively entered a no-growth world. And the question is, do we resume a massive growth trajectory because of things like drill, baby, drill? Or is this the first signs of peaking and rolling over? That's what the question really has to come down to. And again, I think one of the powerful things that gives us a lot of confidence, predictions are particularly useful, and I hold a lot of weight in them when they're made in advance. It's easy to look back and say what happened, but when you make a prediction in 2019 that 2024 is going to see a dramatic slowdown, and we quantified it, and that's what we got, I think that means that our models are predictive. It means that our models have picked up on what's actually happening, and that what's happening is a geological issue. COVID's different, right? No model could have predicted COVID, but when we're talking in 2018-19 that the years of high growth are done, and by 2024, 2025, we're going to be plateauing and beginning to roll over, and then it starts to happen, I think it's telling us that our models are at least well calibrated and that we're picking up on what's actually happening. And according to those, which we have a huge amount of confidence in, we're willing to take this position that this move from high growth to no growth is the first step in going from no growth to negative year-on-year growth.
I don't know that anybody's prepared for that. But again, just to summarize this, if we take the experience of the 70s, it wasn't price and it wasn't more drill rigs. What about productivity? I don't think we've talked about that, because that's one of the refrains that's out there right now is, oh, Chris, Adam, these drill rigs are getting much more productive. And of course, the EIA tracks drill rig productivity and looks pretty spanking good. What about productivity?
So
technology.
You're spot on in the sense that if you look at the 1970s and we increased activity and production fell, the other lever just in the spreadsheet of that, the arithmetic must be productivity. And sure enough, productivity fell quite a bit. You rammed up the rig count a lot, and your average productivity per well measured in, the first 12 months production per well fell quite sharply over that time and offset any of the increases. And that's why production, fell. Your base declines picked up a little bit. That's the other part of it. And your new well productivity started to decline. So then you fast forward and you look at today. And like you said, productivity in the shales is much more complicated, because when you look in the last 5, 6, 7 years, productivity has gone off the charts. And why has that been? That gets back to the original reason we put together the neural networks. If you look at the industry, they'll tell you that productivity keeps going up because they're figuring out better and better ways. They're making everything better. If that's true, maybe it's sustainable. Maybe it'll keep going up. But it's not been the case according to our models. According to the neural networks and the AI, where we can start to disaggregate the drivers of that productivity increase, it has all been moving from tier 2 locations to tier 1. If you had one well here, cost 6 million barrels it's going to ultimately produce 500,000 of recoverable. And you have one well here that's 6 million barrels. It'll do 1 million barrels of recoverable. You moved this one up here, and your blended productivity went up. And everyone patted themselves on the back and said that's going to continue. The problem is this is now all drilled, and you have to move back out here. So what's the data showing us? One thing that I would caution analysts on, or listeners, readers, whatever, is the productivity numbers. If you compare them from 2016 to today, it's night and day. They're not the same. And it's because of the high grading effect that we talked about. We quantify that 80% of that increase has been where you drill, not how you drill. But the other thing that a lot of people get wrong, and the EIA puts this out, and I see lots of people get it wrong, is that they look at productivity per well and not productivity per foot. And the reason that's so important is that you went from drilling a 5,000 foot lateral to a 25,000 foot lateral, meaning you now have 25,000 lateral feet contacting the well, the formation. That well better produce more oil. I mean, if you did that and produced less oil or the same amount, you'd be in a lot of trouble, right? So you need to look at it per foot, and the per foot numbers are not growing nearly what the aggregate well numbers are because we're drilling them longer and longer and longer. And of course, when you think of your tabular cement block that is your shale, if you're drilling out these long laterals, I mean, you're just chewing up more available acreage, right? You're not adding more to the pie, you're just getting at it faster. And that's been, the other, I think, big misconception that people have made. And what really bugs me about that is that in the 70s and 80s, it was entirely normal to talk about vertical feet drilled. Everyone talked about how many, what the productivity per foot was. No one talked about per well. And today, even though it's a much bigger driver now and a much bigger change now than it was then, people have gone back to talking about per well, and they've sort of given up on talking per foot. So I think those explain the productivity trends. If productivity organically improves, it would be bearish for the oil markets. We see no sign of that happening.
Well, that's fascinating, and because, people say, oh, well, technology improves, AI will somehow solve this. I'm not clear how that necessarily works. Maybe you can get a better drill. I don't know. But I don't think anybody's really ready for this, and at least I would invite people listening to burrow into it and then dispute it. I love data. I love challenges. It makes my thinking sharper. But as we come through this period now, what is your larger investment thesis? Because we really burrowed in on oil. I think all things flow from oil, and everything else is a derivative and possible. You mentioned nuclear before. Let me just very quickly, for everybody thinking these are not totally interchangeable substances, because I drive on asphalt roads, and there is no better surface than asphalt for tire grip, all weather, cold, hot. It's like this miracle substance. I don't know that we're going to be making nuclear-based road surfaces anytime soon. So we still need oil, I think, for all things industrial. But you mentioned nuclear too, and just to round this all out, to me, this feels like we're talking about energy has to be a huge resurgence here across the world, but in the United States, China's way out in front of us on this in terms of installing nuclear reactors, coal-fired plants, alternative energy. They're hitting it. What do you think is going to happen in the United States, and how do we turn that into an investment thesis?
So, yes, China is way out in front in terms, I think, thinking through its energy security. And there's a really good reason for that, is that, compared to the United States, China is much less energy secure than the United States. They have a lot of coal reserves, but they have very little in the way of oil and natural gas, certainly nothing compared to like what we have here. And of course, they're, big economy, and they're, consuming far less on an energy per capita basis than we are, probably a quarter as much, if even that. So they see a big challenge going forward, and they see, a big threat to their sovereign security, frankly, the same way, not dissimilar to how we felt in the 1970s, very beholden on foreign energy supplies in an environment where the people supplying that are increasingly, relations with them are not as good, right? And so they worry very much about the Straits of Hormuz, and if you look at the war games that play out, if China were to invade Taiwan, the first thing that would happen would be that the U.S. Navy would shut the Straits of Hormuz, and China, I think runs out of oil. I think it's in 9 days or something like that. So, they're definitely thinking more strategically. And in the United States, it's both a blessing and a curse, but we've been very, very well endowed with huge, abundant energy resources. And so we've had, to some extent, the ability to kind of punt, to not really think too much strategically, to not have to worry, because we've had this era of abundance. We can't dismiss that. We have, on gas, it's been incredible. We have basically shut down most of our coal-fired power plants, no country's reduced more CO2 than the United States has in the last 15 years. It has nothing to do with windmills, I'll tell you that. We went from being a large LNG importer to the world's largest exporter. No one expected us to do that. We built all kinds of petrochemical facilities and everything like that. And, gas prices in the US are still 80% below the rest of the world because we have a lot of gas, but we don't realize it. We don't appreciate it. And we don't understand that you need to continue to invest in those resources over time to avoid shortages. And the energy business is boom and bust. Capital flows in, we bring on too much supply, prices collapse, capital flows out. And we're going through what is likely the worst boom bust cycle that we've ever seen. The shales help precipitate that. They brought on a lot of supply, a lot of capital flowed in. We brought on a lot of production, and now people are just running away from the industry entirely. So yes, energy writ large is going to be a huge investment theme because we need to recapitalize that industry. Why we like nuclear so much, and our view has changed a little bit over time. We first became nuclear bulls in 2018, and the reason for that was that prices had fallen 90-ish%. No mine in the world could operate, even on a cash cost basis. Forget about incentivizing new mines. You were shutting down existing mines. Post Fukushima, there had been concerns that, we would shut down the world's nuclear reactors. We did some, Japan took theirs offline for a while, and Germany as well. But by 2018, we were quite convinced that anyone that sort of wanted to had, and that we wouldn't see massive new shutdowns other than what had been announced at that point. And the market had actually slipped into a deficit, and it was being obscured. And what was obscuring that deficit was these big stockpiles that Japan had taken following Fukushima, because in Japan the idea of a sanctity of contract is very, very high. So they easily could have declared force majeure on their uranium import term contracts because they didn't have any more reactors, but they continued to take delivery of all that material and they just warehoused it. And so the market slipped into a deficit. Mine supply was not meeting reactor demand, and the Japanese stockpiles were making up the difference. So what we did, the best investments are always done on the back of a napkin. We just very roughly calculated when those Japanese stocks would exhaust themselves. We said we want to get involved then, and we did. So that was the story back then. It had nothing to do with a nuclear renaissance or the SMRs. But one of the things that we like so much about nuclear, which is now driving the story going forward and is going to be unbelievably bullish. You talk about peak prosperity. We're about to enter into a century of unbelievable abundance, and it's going to come around because of the widespread adoption of nuclear energy and SMRs. And why do I say that? Well, if you look throughout all of human history, we went from hunter-gatherers to domesticated crops to eventually coal to oil and natural gas. And every time the energy efficiency, which we measure, we call it EROI, the energy return on investment, you put in energy into the system, you get usable work out the other side. It went from about 3-to-1 for hunters and gatherers to about 5-to-1 for domesticated crops to about 10, 15-to-1 for early coal, and eventually to 30-to-1 for oil and gas. And each time, what happened? Moving from hunter-gatherers was like the dawn of civilization in the written word. Going into the Industrial Revolution, going into coal brought about the Industrial Revolution, and moving to hydrocarbons brought the modern world that we know today. Now, again, 2, 5, 10, 30, new small modular reactors have an energy return of investment of 180 to 1.
Wow.
And so this next step could be the most incredible that we've ever seen. And the reason I think it's so important is that it also, besides efficiency, which is really the only thing that matters, these new small modular reactors address 3 major concerns that people have had with nuclear. The first is capital cost. They're smaller, so the aggregate dollars at risk are lower, but the capital efficiency is probably about 70% better than it is with conventional nuclear reactors. The second reason is safety, because a traditional nuclear reactor, which mind you is incredibly safe, it's by far the safest form of electricity that we have. If you look at deaths per kilowatt hour produced, it's far below anything else. Coal is the worst. More people die on the side of a coal rail in 4 months than have ever died in the entire history of the nuclear energy industry. But they do have pressure in the reactor. You use water to cool the nuclear core. The nuclear core gives off heat at about 500 degrees and water boils at 100 degrees. So you need to keep that water under pressure and you need to pump it. And if you lose circulation and you lose pressure, you have a problem. And that's why you put the entire thing in a pressurized vessel and you put the whole thing in a containment vessel, and the steel has to be 6 inches thick and sit on a huge concrete foundation. Small modular reactors, particularly 2 that I'm thinking of, they use sodium as the coolant. Sodium boils at like 12 or 1500 degrees C. So it doesn't run the risk of boiling off. It doesn't run the risk of having to have high pressures. You don't have a steam leak anywhere. And if you walked away from the whole thing and it disconnected from the grid, that sodium pool could absorb all the heat coming off the nuclear core over its lifetime. So it is what they call walk-away safe. The third thing is waste. Everyone's worried about waste. No one realizes how little nuclear waste there is, or that nuclear waste can be recycled. France recycles its nuclear waste. It creates no waste at all. But nevertheless, these small modular reactors, because they use a different form of fuel, will actually create 90% less waste per megawatt hour, per kilowatt hour. So cost, safety, and waste, all 3 of those get removed, and the EROI is by far the best we have ever seen in the history of humanity. So I think prosperity, I'm in a bull market for prosperity.
I'm so glad you went down that hole. Brilliantly said. I'm such a fan of the small modular reactors. In particular, I'm jealous of China. They've got a pilot thorium reactor. I'm super happy. I think I would love to see us exploring on that. I would love to see many billions went into Ukraine, go into, small modulars and all of that. Do you think, will our new energy secretary, run that? Nuclear is a political hot potato, I guess, here in the United States. Do you think he's savvy and wants to go at that? And can he get regulations out of the way for us?
So I think he's certainly savvy. He actually sits on the board of Oklo. I'm sure he's recused himself.
I did not know that. That's good.
Yeah. So Oklo being one of the 2 sodium small modular reactor companies, actually not publicly traded. So he's definitely up on small modular reactors and presumably favorably disposed, since he dedicates his time on a professional basis before being the secretary to sitting on that board. The big hurdle for small modular reactors remains actually not so much political. It's oddly enough, nuclear has been a fairly bipartisan story. We've seen, for all the talk on Democrats and their energy policies, we've seen a lot of support actually from across the aisle for nuclear in the last 3 or 4 administrations. But the big bottleneck has been what's known as the Nuclear Regulatory Commission. And I think there's a lot of reasons for that. After Fukushima, they did not want to be accused of, buddying up with the industry. And in fact, they went so far the other way that their job seemed to basically be to regulate the nuclear industry out of existence, far different from the FAA or the FDA or what have you. And that's proved quite challenging to change the culture at. We could argue about why, but I suspect that, if you're President Trump and you want to, bring in Doge and change federal work from home initiatives, that seems probably a little less scary than gutting your nuclear regulator. because even if you have really strong feelings about it, the people are in that industry, and I think if ever, God forbid, something were to go wrong and you were the guy that gutted the NRC, there's probably a little more scrutiny there. So that's proven a little more inertia there. The regulatory agency claims to be very pro SMRs, and they're looking at it intently, but we don't really have much in the way of actual approvals or permits that they've granted. So right now it's a big open question mark. When people have asked me what the U.S. could do to really improve its energy policy, to me it would be gut the NRC and put in place people that were more keen to see safe nuclear power go forward. But obviously that's proved problematic.
Well, let's hope maybe we can get some movement there, because I do think, I agree, this could be, let me be very blunt. My townspeople would hate it, but if I could sign a piece of paper, I would have one of these SMRs in my backyard.
Yeah.
I would.
It's funny, we've talked about, here, how do you address some of the NIMBY issues, not in my backyard? And, it strikes me like if you said, okay, look, everyone within 20 miles gets free electricity for life, you probably could alleviate it awfully quickly. You might have people competing, for where to place these things. And they're completely safe. These new generation, frankly, the old generation was completely safe too. The new generation is fundamentally by design almost completely safe. And so I think that when you look back, these small, sodium-based small modular reactors, when nuclear power first was being introduced in the United States, it was overseen by the Navy. And Admiral Rickover was the admiral that's sort of in charge of the program. And he was presented with both pressure water reactors, which is what we use today, and sodium reactors. And all the advantages of sodium reactors were presented to him. And the one downside of a sodium reactor is that hot sodium and water are not always the best of friends. And so he felt that if you're going to put these nuclear reactors in submarines, it's probably best to have the one that could be less susceptible to hot sodium fires. And who cares if the costs are higher? Who cares if it creates more waste? Who cares if all these different things? The tail risks don't matter. What we don't want to have is a water recursion problem on a boat that leads to potential problems with the sodium reactor. And so that's really why the Navy went in the direction of pressure water. And Vaclav Smil, the energy scholar and historian, has said that basically every nuclear reactor that's ever been built is nothing more than a beach dry docked 1960s submarine. And that's true. So the question is, can we do better? And I think we certainly can.
Well, that's great. So as we wrap up here, I will note that one of the charts I saw in your presentation too is that commodities are maybe ticking up a little bit here, but certainly compared to stocks, general equities is a very hated area. So from a contrarian standpoint, I'm interested. How do you think of commodities going forward? How long, if this is a bull market that's about to begin, how long do those tend to run, and how do you position for that?
When we started Gary and Rozencwajg, we were at another firm for that, and we started Gary and Rozencwajg in 2016, and we decided to launch a mutual fund as opposed to a hedge fund or private equity fund or an ETF or whatever the case may be. And Jim Grant had us on his podcast very early on, and he said, wow, this is a contrarian twofer. It's a natural resources mutual fund, at a time when mutual fund issuances were basically zero and natural resource anything was zero. So we're contrarians too. This is going to be an unbelievable cycle. Commodities have never been cheaper relative to financial assets other than 2 years ago, but this cycle was made an all-time low, and you're still at the 99th percentile. Don't hold me to that, but you look at the chart, we're right at the absolute bottom in terms of that valuation band. Every time has been really good for resources. Every time has represented a time when money's flowed out of the space, and that's always a good time to get involved, and that's where you are today. So I think realistically, things have a funny way of working in decades, and I think that in 2020, when we made the COVID lows, I would have said 10 years. That sounds like a good bull market run to bring capital back in. But here we are, it's 2025, and energy remains 3% of the S&P. We've seen nothing in the way of new CapEx spending. Ultimately, that's what's going to end the bull market. That's what's going to create oversupply and eventually usher in a new bear market, is going to be too much investor capital and too much spending. Because remember, commodity prices rally, these companies earn supernormal profits and money flows in, but it takes 5 to 10 years to bring on new capacity, new mines and new oil fields. And so you have this period of time where too much money comes in because those supernormal profits last for too long. It's great while it lasts, but it ultimately brings in too much capital and it sets up the next phase of the cycle. So here we are in 2025 and we haven't seen any capital come in. We haven't seen any new mines being sanctioned, any new oil fields of any major import coming online. Nothing like the shales, looming down the pike in the next couple of years. So I would say probably 10 years from now at the very least, if money started to come in. I do think that this year will be a very interesting year for commodities and ultimately very, very bullish because we have lots of supply disruptions. The market's very, very tight. Inventories are low and everything from oil to natural gas to uranium. And what we noticed is that the big kind of catalyst to end these bear markets going back 150 years has been sort of a change in how we approach the global monetary system. For whatever reason, it's probably a topic for a whole other day, but you get this period of time when money, interest rates are low, volatility is low, money flows into abstract stocks, growth stocks, high multiple, high duration. It starves our industry for capital. And what ends that? Well, it's basically that imbalance gets so big that you change how you do the monetary system. In the 1920s, we abandoned the classical gold standard. In the 1970s, we abandoned Bretton Woods. In the 1990s, we abandoned Southeast Asian currency dollar pegs. These are big, big moves. And so when I hear what the Treasury Secretary is talking about today, and when I hear some plans being put forward, I wonder if that's not going to be the same thing that happens this time. A couple years ago, I wondered if it was some of these BRICS currency blocks, but now I think it's probably going to come domestically from a change in how we operate. And if you listen to Secretary Bessent, he talks very openly about needing to realign global capital flows and change the system. And I would watch that space very closely.
Yeah, he's been saying it's going to take me a while to analyze and really understand what he's up to. He's very smart and he's very well read and he understands his history. That's clear. I'm actually pretty impressed so far. So I don't quite know what the total impact is going to be, but the tariff regime is going to change a lot. We could see capital flows really. That's an interesting hypothesis. I'm going to have to look into that some more. That's fascinating. So we're going to have to do this again. I've got a lot more to talk about. And I just want to thank you for your time today. I want to direct everybody to this, your commentary from the third quarter of 2024. And check this out and read it. I read it a couple of times just to make sure I understood that depletion paradox. But copper and uranium, big stories there as well. Kind of similar, underinvested for too long. Not a lot of copper mines. We've all seen well, maybe not everybody has. The stuff I read, from the big analysts say that for copper needs to be 2 to 3 times more per ton to incentivize new mines opening than it currently is. So guess what? No new mines. Guess what? Future supply shocks. Oldest story in the book. So that's resource investing. So everybody go look at this and you can find it. It's gorozen.com. Is that correct?
That's correct. And thanks to Google and AI, if you get our name spelled even 20% right, they'll point you in the right direction.
Yeah. Well, Adam, thank you so much for your time today. And thank you for this work. It's very stimulating. And I think it makes it a very compelling investment thesis.
Thanks for having me.